None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It's Monday morning. We're starting off at new historical highs. Just keeps on cranking. There's a lot to talk about this morning. I've got the schedule up again. We're going to continue to try to do our best to adhere to the schedule that you see on the screen right now, where we're going to do the index review to start, then go through treasuries and maybe touch on some currency stuff depending on what's going on there. We may end up just basically the first half hour is going to be about the markets and a review, and then we'll start and talking about some even a tech lesson or some kind of featured presentation that we're doing, and we'll go from there into actually into the individual stocks review, and we're going to keep that. We'll see how that goes today. Obviously, Apple 7-to-1 split, so yes, your screen is right. It is at, 95, 97, Mitch, something like that. Anyway, so let me go ahead and bring, have Mitch come on board here. Good morning, Mitch.
Good morning.
Go ahead.
Yeah, Apple is trading at 93 right now. So
Yeah.
it's sort of a startling sight to see it split like that.
Yeah, and I mean, I'm not sure what the strategy is. I guess they're trying to get more since it's really a retail company. They're trying to get these folks to maybe own the stock too.
Probably a lot more 20-something, 30-something-year-olds. They're just now getting in the stock market. They want to buy something. Well, $700 stock is pretty expensive. So
yeah, at 700, like 700.50 will be all time, or 100.50 will be an all-time high. I believe it's around 703 was the old high, something like that. Anyway, so that's exciting, I guess. From the standpoint of the markets, not a lot going on. The employment report that came out Friday, we actually managed to recover all of the jobs lost, sort of, kind of, on the we got back to the 2007 and 8 levels from an employment standpoint. The problem is the economy has been degraded. It used to be an A+, now it's a B-. Mostly the quality of type of jobs that were created last time, once again, were not the higher end jobs. It's just, it appears, we're trying to become a third world nation or something, I'm not sure. But just a lot of service jobs, and I guess maybe that's what the equality thing is about. All of us will make $15 an hour, and they'll be happy. But anyway.
They just passed that, and I think it was in Seattle, minimum wage, $15.
Yeah, we'll
see unreal.
See how that goes.
See how that coffee, how much that costs.
Yeah, so, your favorite coffee will go up, too, since the same guys own it, right? They'll have to start charging more. But, yeah, it's just a lot of things going on. We're going to dig into the VPM database here shortly, and we'll go through the dashboard and look at some of where the rotation occurred last week. We're continuing to see some traction come in here. We were at around 47, so the database is up about 10% overall, which 10% is about 1,800 net stocks roughly. from what we've been able to increase as far as the percentage ownership. and it's interesting on some of the things we're seeing, and we'll go through that shortly. As far as anything else going on, I guess ECB, you got to spend your money in Europe now or get charged for having it in the bank. Still trying to figure out what that's supposed to do. I'm having trouble with that one. I don't know. And it's I did some reading over the weekend, and I'm still confused why that's going to be good. But the basic thing that's going on in Europe is not in Europe. It's like I made a comment in the other day are the central bankers really that smart? What is it they're doing? Do they really know what they're doing, other than they're doing anything and everything to make the economy grow? And I guess that's their job. I guess from the U.S. Federal Reserve, it's supposed to be, to get to full employment. It's just, I guess they don't care what type of employment anymore. So it's just full employment, whatever that means. Not to mention, what is it? Something like 7 million people have dropped out of the workforce in the last 5 years or 6 years, something like that, since the crisis. So
yeah,
I don't know. Maybe that's just a bunch of us folks, us baby boomers, just bailing out and just saying screw it, and we're going to go, sit on the couch and get fat and ugly and old at the same time. Maybe that's what's going on there. But anyway, there's definitely a movement of some sort going on in the labor force, and who's playing and what's going on, and housing's still a joke, all that stuff. So let's go ahead and I'm going to go ahead and get over to looking at some charts here. First chart that's coming up this morning is the S&P weekly, and you can see that it's just continuing that stair step. Just to kind of reference the ppms, we're at 0.48, 0.30, and 0.41. This continues to see an expansion. If you recall, wasn't that long ago. Matter of fact, before I comment, I want to switch over to a monthly graph here, real quick. Yeah, this has also been happening on the monthly, where we're seeing the ppm1 moving faster than the other three, which means that the trend is still expanding. So when there was a sign that this was not going to be the case, this last month and a half of action pushing up into this 1950 range has re-accelerated the trend from a monthly standpoint, going back to the weekly graph here. From a weekly standpoint, we're at 0.48. That was down around 0.27 to 30 just a couple weeks ago. So this surge out of this range here has revigorated this trend, and we're seeing the ppm1 moving faster than the 2. It's moving faster than the ppm4 now, because it was about the same. It was around, I think, 4.3, so it was just slightly better. These indicators are updating real time right now. So we're looking at the S&P up 516 right now. We had a high intraday of 55.55, which is S2 or R2 on our daily scale as far as what the expectations. Resistance 2 was 1955.40. So we got up to that level so far today. And we'll look at some of the short-term trends to look and see how that's going. If we just go down real quick here to the daily trend, you'll see the acceleration even more obvious. We're at 0.28, which is a short-term trend right here from the ppm2 is at 0.19. That's continuing to improve a bit, and we're at 0.16. So we haven't got a full-blown acceleration on a short-term basis, but we definitely have some pretty good support right here, and the trend is seeing some acceleration here. I just want to bring up a couple numbers here. 1928.66 is the 10-day moving average, and if we go here, it's rising about 5 points per day. So if the market were to stabilize here, it would take about 3 days or so, and the support would be right pretty much where we are because of the acceleration that we're seeing in that average. So the result has been that we're seeing this trend accelerate. probably the most reviewing fact on this one. I was looking at this earlier. Let me bring up the whiteboard so I can point this out. This PPM3 is, all three of these are accelerating, but PPM3 has just exploded out of this level, which means that this 40 period moving average is starting to trend up. If you recall, in the Market Thunders session I've been doing, when the trends start to expand out, this is a really strong sign, and we'll get to the maximum level, which we're getting actually pretty close. If you look at over here where I'm drawing an arrow in the middle of the page, we're not quite too close to the peak momentum that we saw in the beginning of this trend. When we go back into February, we made those lows early in the year when it looked like the sky was falling. We managed to get to, we managed to accelerate pretty hard out of there. So most likely we're going to get in acceleration mode. We're going to get up into these levels where I'm drawing right now. We probably won't make a new high, but we could. And some of the things, and we talk about the database here in a few minutes, there's some pretty reviewing facts that came out. And I mentioned in commentary that one of the things that happened is that we saw the mid cap and the small caps, we actually saw them correct, get into so-called corrective phase at minus 10% plus. And so what we saw was a rotationary correction potentially here. And now we're seeing a re-acceleration, or this trend keeps recreating itself. We saw this more or less in fall of 2012, and early on in 13 we saw this, and now we're kind of recycling things again from a VPM database standpoint, as well as these momentum signals that we're seeing. So we're seeing a lot of the strategies that we had out there that we were 50-60% investment slide back into 100% investment, wanting to participate with this next leg. And we'll talk about some of the potential. It's pretty much the same as what we've seen in the past, but we'll go back to the weekly graph here real quick. And the weekly numbers, let me bring that up. And I'm going to move this over so I'm not in front of that, so you can see that this number scale here. So the weekly, the targets right now at 1973, that is a shoe-in. That's going to happen. There's very little to derail the market. There's certainly no news this week. I think, what was it? Jobless claims on Thursday is about it, and that's kind of not a lot to say about that. It's it's going to be, they're expecting 3,000 less. Maybe you get a better number, but I don't see that kicking sentiment around too much. And retail sales also on Thursday. But in between then, it's a bunch of Fed chairmen talking and not a lot of stuff going on. Maybe a few earnings reports here and there, but nothing significant, it appears, that will drive this market up at all. So we'll take as we look further into this, the upper target range now, 2034 to 2072. We're up 0.25% today, so this thing is inching up. We're up 5 points on the S&P, so we're continuing to inch up. And like as I've mentioned from Friday's numbers, I have that number in my head. We're about 4 to 8% on this target range on the upside. So that would manage to get us up about 8-9% on the year. It's certainly not a 2013. The numbers make it feel bigger than it really is from a percentage standpoint. The game in this market is continuing stock selection. The right stocks will get you a long way, a lot longer. The indices stuff has been really choppy this year from like the typical mutual fund ETF strategies. They're a little more difficult to make any real money in from that standpoint. And even if you're doing any type of even allocation strategy and you haven't allocated out, you're lagging. There's just no way to keep up with these indices, and especially right now the S&P is the leader, and we're starting to see some rotation there. So let's take a look at a couple of things here. Speaking of rotation, let me bring up, and we'll bring up IJR, which is going to be the helps I get the right I fat fingered that. So, bring IGR up, and let me get rid of the strategy here. I just want to have a nice clean chart to look at. So interesting pattern, and what we've seen out of this, while the S&P has been surging higher, this thing has been consolidating and attempting to make a turn to the upside. And let me just get to the right place here. You can see this consolidation pattern that's coming up right here. In fact, this was most likely the high of the actual pattern. It could be counted over here, where you get this A, B, C, D, E pattern. This would be the bottom, and now you get an acceleration back to the upside. So it appears that there is just about every chart that I looked at over the weekend, as I was doing my analysis, continues to point to a reacceleration of this trend. And I talked about this. This is why we went through last week. I think we've got a couple more stocks to get through the top 25, but it's kind of interesting. I guess we almost have to dynamically review that all the time. That might be a little difficult to pull off. But just trying to determine, did all of these stocks within the top 25 in the S&P have to make new highs to push this market up? And the answer was no. Even though some of them are neutral, there were some that were, we'll talk about that in a bit, that are driving this market. So you're seeing an internal rotation, most of the stuff at the top end of the charts. But now with the mid cap and the small caps trying to make a turn here, you're going to get some more acceleration out of the back side of the index and the outliers, so to speak. They can actually do pretty well to drive the markets up if they start to try to catch up with what the S&P's done. So we'll have to see how that goes. But this pattern is pretty much out there. Similar pattern, MDY, and although it's managed to break out, it was the weakest part of this market in the first part of this year was the small caps, and we've seen a big turnaround. And when we go through and looking at the database, you'll see that was evident also from a VPM viewpoint as far as what's responding to that at this time. So having said all that, let's take a quick snapshot here. I want to go over and take a look at our friends over in the Treasury pit, and then we'll go to the VPM database and talk a little bit more about some of the strategies and stuff that is going on out there. So here we are, 261.20. I talked about this last week. 262, 264 is a very, very big resistance, and it's likely to continue that way this week. I don't see the yields getting up that way. I don't see anyone concerned, or should they be concerned, about the movement in the treasuries right now causing any effect at all. If anything, some of the higher prices are reflecting maybe some movement out of treasuries back into equities from that standpoint. So there's the rotation is happening at several different levels. Be bringing Mitch back on here in a second. I just want to go back, and I'm going over to our charts here. Probably what I'm going to do is take us both off the screen here, and Mitch, I'll have you kind of go through and do the review of. Actually, I have a shot. I'll go ahead and start you, and I'll bring you up so you can drive there.
All right. Give me 1 second. There we go.
1 second here. Just bear with me 1 second here.
All right.
Okay.
All right, perfect. Well, as Bob had already mentioned, we saw quite a bit of buying this week. I believe we had 2,200 total buys across the two weekly systems, both the 1.2 and the 3.2. Now, what this works out to be, every time that we take a look at the database, we focus in on the optimized trade system. And as we mentioned in prior broadcasts, we're going to be revisiting the optimization in a couple more weeks on the 1st of July. So across the board, we saw roughly 1,000 new buys when it came to the optimized system. So that makes sense that, if you're looking at the net buys, half of them are going to be optimized, half of them are not going to be optimized. But still, across the board, it's a lot of activity that we've seen on the system. As you can see here, looking at the funds, the largest amount was in this U.S. equity. We took on 15% of new positions, and by clicking on this, I can drill down into the subcategories here. And as you can see, it was really in the small and mid cap spaces where we've been largely defensive up until now, where we saw the largest buying into it. So you see here, small cap, we took on 41% of the funds in the database had a brand new buy this week. So if you had any sort of diversified style box type strategy, you probably saw some activity this week, especially in the small and mid cap spaces. And you can see just going across the board that especially in the values where we saw a lot of the buying both in the small and mid cap, but it really brought us back up. And I think when Bob and I were taking a look at this earlier, that the all-weather ETF strategy, which is a style box rotation strategy, is around 80% invested after the purchases for today. And then the global equity strategies, the various different variations we had of that, I believe all of those are 100% invested. So you're going to see a lot more participation now across the board on these.
Yeah, and as I was saying earlier, you're really looking at the type of rotation that we're seeing is, I guess, has a lot to do with this small cap, large cap situation that continues to unfold. And like I said, the S&P has been really the steadiest index out there from the standpoint of, from a trending standpoint, it managed to stay stable when the other indices were declining, and the small cap was the weakest. And of course, everybody's talking about the momentum stocks. We could bring up a couple of those, but that's pretty much it from that standpoint.
Yeah, I mean, if you look at the small mid cap space, the indices, the small cap, the S&P small cap index, I think that had a 10% pullback earlier this year. So certainly they've gone through its sort of cyclical fashion up here at the top to pull back some, and now we're starting to see some new trends form on that, which we haven't yet seen so much on the large cap space with the S&P 500. Going a little bit over to the sectors now, you can see that much like last week, the buying that we had was really across the board. There wasn't necessarily any group that had significantly more concentration. It was pretty much broad-based purchasing across the board. Last week we took on about 1% new positions. This week, as you can see, that it varies from 3 to 5% depending on the specific sector that you're in. And then as you drill down to this, so for example, if we go into cyclical goods here, you can see the purchasing that took place across there. We're seeing a lot of retail starting to have new positions come on board. I know a lot of earnings that got released over the last few weeks have shown weakness, at least initially. So it's interesting to see a lot more buying in the space to see if that weakness has sort of bottomed out and if we're beginning to form new trends on this. Going back up, if we go up here, under weekly research, this is where we do some consolidated looks across these broad sectors or thoughts when it comes to ways of investing. So we have various different groups on here. So you can see we have a commodities where we've grouped gold, oil, and silver. We've also had put up a fairly diversified mutual fund type approach. You'll see on that one that we really didn't have any buying on that. And then going down further, we can see the new buys that we had across the globe. So I know a lot of advisors have been starting to look at some more ideas when it comes to the single country ETFs out there, and we're tracking the iShares for this. So you can certainly look to this as a source of ideas. But you see down here on the major markets, which reflect the same positions that you're going to find in your global equity strategies. We had that brand new buy on SPY and MDY here in this chart.
Yeah, Mitch, you notice, look at, scroll up a little bit and look at Spain, up 39%. And I'm telling you, I'm like kicking myself because all the best opportunities were in all this stuff that was supposedly the end was coming. Spain was, Portugal, all of those countries, Greece. They were when I guess the bottoms were coming in 2000, late 11 and 12. Man, there were just some amazing opportunities there. I'm just
Right.
kicking myself that I missed that.
Well, it's very.
I guess
similar to that.
BPM didn't miss it, but
Yeah.
but you've got to think about it to have it on your sheets. You've got to have that rotation, and as Mitch mentioned, we seem to be getting quite a bit of interest in folks building some kind of rotationary international strategy. So we're looking at how to facilitate some of those ideas right now. I think there's probably some pretty good logic there, although some of it may actually be hindsight as well, because just looking at like the Spain, a lot of those opportunities, at least the big opportunities, have maybe passed by. Now it's more of an incremental, and Mitch has brought up the globe at a glance here. You can kind of see, was this just last week here?
Yeah, this is year to date right now on Russia as of last Friday. One of the things that I think is interesting is, just like we've had a nice rally of about 5.5% year to date, or new gains for the year. Russia's had a pretty nice size rally as well. They had been somewhere around 15 to 16% down.
Why don't you
They're
bring
now-
up the quarter and show the
Sure.
yeah.
Give me 1 second.
Yeah, so you can change these charts, folks, and so we'll look at the quarterly review, and this market has just been on fire on the upside, so
Yeah, so you can see here on Russia, we had a nice gain of 14%. So after, I guess, the initial news about Crimea, this is certainly is showed some gains on it, and we've probably seen the strongest activity in the international space, which last year, of course, had the weakest markets across the board.
I did some thinking. Why are these things happening? I had a synapse fire over the weekend. It was like one of those where you slap yourself in the head and go, "Why didn't I think of this?" But let's face it, all the central banks, no matter what country, even in China, what they're trying to do is keep these economies growing. They're trying to keep the children and the people happy, and they got jobs and all this stuff. And it's like, I don't know. I've never seen. In my 30 some odd years doing this obsession at pushing the markets at this level. I think it's the fear of falling back right now. So the central banks are being driven by this fear. But here's my point: is what seems to be happening anytime one of these things get knocked down, whether it's Turkey or Russia or any of these in the past, Spain and Portugal and all those. The central banks are saying, "Don't worry, we're going to support it," and they have done just that. So, I don't know if that scenario can keep on keeping on, but it sure seems to be obvious. Hindsight's pretty obvious sometimes. But these folks at the central banks aren't going to let these things fall back. They're fearful of it falling back, and maybe it's fear of social unrest, and maybe things like you saw in the Arab Spring and other elements that with Twitter and Facebook and all these social environments out there, people can organize pretty quickly to go, if they're going crazy, to cause the anarchy kind of syndrome. So it seems that, I don't know, just my synapse was that it appears to me that these central banks are all operating out of some sort of fear, and they're willing to go anywhere, do anything, have negative rates on savings accounts, pump money anywhere they can just to keep this thing from even looking like it's going to roll over. Like the thought of a recession is unacceptable from this point forward, and I think there's risk in that. Could be wrong. Maybe they can actually manage it. Maybe all of these bankers are as smart as they're trying to be anyway, and maybe they know things they're not telling us children out here. So anyway.
I don't know if it's a good analogy, but it just makes me think of like the participation trophies for kids at soccer or something like that. It's
Good
the
call.
market doesn't want anybody to feel bad about the state of the economy, and so what they do is they prop it up any way they can to make them feel good.
So I guess the PC police have now taken over the markets too, right?
Maybe.
So I don't know, but I mean, I think the discussion here is interesting because there is an element out there that is driving it. So, when we see the market go flat, it's this obsession still there to keep things going. The U.S. economy, while it may not be growing at these crazy rates, as I said, close to maybe it's been 3.5, 4 years ago now. It's not, all it needs is to have some growth. These companies are going to figure out how to make money in this. And if you look at what's happened in earnings, we have the highest earnings ratios that we've seen as far as the amount of money that these companies are making. They're just making money hand over fist, and that's what we're investing in. So it's like, while the big talk of income equality goes, all the money's going into rich folks' pockets with this that own stock, and that's where those are the assets that are changing. Obviously, it's visible because of what we do for a living, but you can see real estate. You're seeing, all of the. If you own real estate, that's certainly done better coming off the lows. It's certainly not doing better here in North Scottsdale. I can tell you, it's continuing to be a little weird with stuff. But there's a fair amount of building activity and stuff, but we're not seeing that kind of recovery that you'd like to see. I mentioned on Friday just briefly, I think that the crisis has actually changed how people are reacting. Maybe it's reconstructed the economy, and it's rotating from what it used to be to this construction-driven situation to more of a service-driven. I don't know what the shift is. I haven't got a handle on that yet. But there's a shift going on in how people are thinking from the standpoint of I guess economically, what's driving it, what's driving these numbers, and that's why you're not getting the big numbers, because you're not getting the big construction spending. You're not getting I guess we're getting into kind of an M&A cycle where people are starting to buy things with cash and do those type of strategies. So that's less stock, higher prices. There's all kinds of elements that have been building in this market as we look back in the last 18 months, really. So sorry to get babbling on about that, but it just seems like there's something going on there that seems maybe obvious, but in hindsight it'll probably be 100% obvious, like it always is, right? But trying to be forward thinking, it appears there is something going on here, and there is a shift in some of the social trends and how people think, and certainly with what the current governments and Western governments are doing. And China's in this thing too, because they're constantly trying to keep their economy growing and keep moving. Obviously, their goal is to move more and more people over into their middle class, and they've got a lot of folks to move. So it's something they got a long path to do. So I guess it's time to maybe do the stock of the day. Did you have anything else in closing here?
No, I mean, I think all that you said is right on as far as it'll be interesting to see where the market goes forward when it comes to social trends and market sentiment, especially for the average investor out there. Certainly the big institutions are buying. It'll be interesting to see how that affects the average retail investor going forward.
Yeah, I think retail guys have been coming back in. I mean, they even got Hugh Hendry to get long, Those of you that don't know Hugh Hendry, you can look him up on the internet. He's a fund manager. He was a keynote speaker for us a couple years ago at one of our conferences, and he's kind of disappeared. He went from being very public to the point of even me managing to get him over here from London to speak, and it was a very interesting speech. And I saw an email by an advisor the other day wanting to know what he's talking about. I've tried reaching out to him. He told me probably close to 2 years ago now that he was kind of going underground, so to speak. Some people that put money in his funds didn't want him hanging around CNBC in Europe and running around doing all these conferences and stuff. They unfortunately, he hasn't done very well since he went into hiding. But the bottom line is he had capitulated in the beginning of the year and said, well, the trend's going up, so he's now long, and I can't say he's been wrong at this point. So, but let's go ahead and let's go back and see if we can do some analysis. What do we have? A couple left from getting through the top 25, I think.
Yeah, we have two left on the top 25. That's Walt Disney Company as well as Intel. So DIS.
Yep.
And that is currently, bear with me a second, I'll only pull up the optimized trade system. That's on the 1.2 weekly.
Okay. So that has been long for a while. And yeah, this is obviously this is also a Dow stock as well, right? Isn't that in the Dow Jones? Disney, I think it is.
Yeah, I think so.
I haven't looked at Dow Jones in about 20 years, so I have no idea what's in it anymore. They're always switching things out. Matter of fact, I was looking at our S&P 500, the PPG 500, and I was it just snapped at me this morning. It's been there all along, but one of those things where when did that happen? But it has a total constituents of 803 stocks. So since 2000, they've almost completely 100%. Let's call it 60% of the S&P isn't even the same as it was in 2000. So 803 constituents out of 500. So we got 303 changes in the S&P. So I've always convinced that Dow Jones, McGraw-Hill, they want their indices to look good, and they're always rotating stocks out. Some of it is driven by capitalization and changes. Others, Dow Jones in particular, is kind of a committee choice. I've never liked that index just because it's not. I don't even know what it is. The Dow Jones Industrial Index.
It's not industrial anymore.
I don't know what it is. It's just it's a list of 30 stocks, and they probably should change the name. I guess that would be beyond taboo, I guess, to do something like that.
You can't change your branding at this point.
Exactly. Not after 150 years, right?
Yeah, but it is Disney is on that list as well.
Okay, I thought it was. Anyway, this as we've talked about before, PPM's all screaming 0.64, 0.70, 0.81. This thing's positive, and it is not an expanding trend, so it is starting to mature a little bit from the standpoint of looking at the PPMs for a moment, but this needs to be watched. I haven't really looked at this very much at all, but we are seeing some general acceleration on the underlying indices. So from underlying PPMs, the 21 and 40 period moving averages are moving at pretty brisk levels at 0.7, 0.8 doesn't sound much, but that's a percent per week change, and that's quite a bit when you have a 40-day or 21-day, in this case 21-week moving average is moving at that pace is pretty good. I've seen these in the upper 4 or 5 percentile ranges, so it's certainly not an extreme, but if you looked at a Netflix or something that was going vertical. But this is a real steady trend. We've been in and out of it since let's see here, back in October 11, but we bought and sold it pretty well along this trend line. And this is pretty much what, one of the things that we feature when we're talking about these stocks is just how VPM responds to within an elongated trend. We're looking at what, almost, not quite, getting close to a 2-year trend. So when you get in, most trends are minimum of 12 months, most are 18 to 24 months. And in this case, we've seen this stock double in the time from the lows anyway. It was below 40, and now it's 85. So during that time, we were managing the risk in this trend. We managed to also participate in well over, it looks like, probably 70, 80% of this trend on the upside. So that is something we need to, that's what we want to do. This is perfect, because you never know when we sold over here in the middle of this page whether that was the end of the trend or what. So what's our last stock?
Last stock is Intel, INTC. And we are also on the 1.2 system on that one.
So this one's long. The last high here, let me bring up just for a second here. Let's see if we can bring up I click the right button, maybe that'll help. So we'll bring up this last high up here was 29.27. We're 28.24. We're pretty close to punching out a high. We didn't look at on Disney the longer term stuff, but let's go and take a look at a monthly graph. This is another one of those stocks that may never see the 2000 highs again. You're looking at what somewhere, looks like that was probably it right there at 75.83. So she ain't what she used to be. Let's put it that way. But the bottom line is, even on a monthly basis, there is a trend emerging here. BPM even has a long-term gain on that as well. So let's get back to this trend. We're seeing 0.78, 0.44, 0.58, all really good trends. This thing's not going away anytime soon. It probably will manage to get to a new high. This is one of the players. This is one of the top 25 in the S&P index, and S&P's going to new highs. This one's probably going there too. Some of these stocks that we looked at, Mitch, have you summarized while we're sitting here?
Yeah, so a couple different things that I think is worth mentioning. These top 25 stocks actually represent almost a third of the overall index. So even though there's 500 stocks, they represent 31% of the total holdings thereabouts.
Yep.
So across the board, we see that it's about 40% 1.2, 60% on 3.2. So we have a pretty typical blend of the two different trade systems when it comes to optimization. And 48%, based upon the analysis that we've done, 48% show positive, 8% show that neutral positive, so it's beginning to show that positive trend in place.
Yep.
36% show neutral, and 8% show negative. So that's some of the raw breakdown when it comes to this. One of the things that I think is also interesting.
And that was Bob's seat of the pants analysis on those trends. So as we went through them live, but I think it was pretty easy to figure out a lot of that stuff.
Yeah. One of the things that I also think is interesting is, as of last Friday's close, the S&P 500 closed up. I believe it was 5.5%, thereabouts. If you were to equal weight all 25 of these positions, or really 24 positions, Google is actually counted twice on the list because of the two different share classes, but still both represent the top holdings on it. Year to date, as of Friday, the gains on those positions is only about 3.75%. So you see that there's still a gap between what the top holdings are showing versus what the overall index is doing.
Yeah, and I think if you go to the top 50, you end up in, close to 40 percentile of the entire index, just in 25 more stocks. I think it's something like that. The top 50. So a lot of people that are running S&P baskets, they don't run 500 stocks. They run around 100 stocks. You can emulate that index pretty accurately from a proxy standpoint. So a lot of program trades that they're trading the thicker stocks. They're not going into the outliers, and they're not necessarily trying to build any kind of alpha value of any sort. They're just trying to make it look and act like the S&P, so they can trade against it, options and futures and what have you. I worked in a delta neutral fund in San Francisco, and that's what we were trying to do, is just trying to add alpha, and it was we're always offing the any type of beta risk we have. We were always adjusting it constantly all day long. We had 14 traders and two master traders, and the master trader that I worked with, he was pretty intuitive guy, but also very one of the biggest traders on our exchange at the time, and we had about $500 million, like $450 million on in that fund, and it was just constantly just trying to adjust. And there's a lot of folks out there still doing that. It's been years. Probably 5 years ago, I was talking to those folks, and they said it ain't like it used to be, and some of the stuff we used to get away with to pull money in off the street isn't the same anymore. Decimalization, some of the volatility, and some of the option strategies have been more difficult to achieve from that standpoint. But bottom line is, these stocks are driving the markets, and that's what's keeping things going. The trends are there. Some of these that were neutral it'd probably be interesting. Maybe if we get bored toward the end of the week, we'll try to come in and maybe look at some of the neutral stocks to see if they've emerged this week, and maybe to break out, because that's certainly a possibility that we're seeing even in the neutral stocks. How many were neutral, Mitch?
Bear with me 1 second. Let me pull up my list again. 4 were not neutral. We had 11 total that are neutral.
Yeah, so all it takes a little bit of shift in those 11, and now all of a sudden you got the index moving up again. We're not really. It's not like. And this is another thing. Just real quick, while we're talking about some of this rotation and these top stocks, the indexes themselves I don't expect to see these vertical explosions from this level. You're going to see these quarter, 0.5% days, and it's just going to grind in your face. The volume's going to stay low. The folks that don't want to believe this rally is real are going to talk about volume and everything else. They're always going to try to badmouth it somehow, the fact that there's low volume, that the price action doesn't matter, and it does. But the bottom line is this thing is going to grind up. I doubt very much that we see an explosive move. And if we did see an explosive move, let's say it broke out and everybody goes into panic, I got to own stocks. It still fascinates me at these levels where we're at that there's this unbelievable anxiety as the market's going up to own as much as you can own. We now are back. We're back there from an index standpoint, and from many of our strategies, we've definitely upped the ante, and we're making a bigger bet here, and it's because of trends. It wasn't because of a hunch or anxiety, and that's part of what we're doing here is looking at these trends when they emerge, when they show up. They show up, and it's. I guess from a modeling standpoint, it's our job to make sure we're recognizing those things that they're happening. But the reality is that we have to participate. We can't just go, oh, there's a new trend. We got to get in. We got to put the capital back to use. And if it happens at S&P 1950, so be it. That's the way it's going to go. I remember not that long ago feeling anxious about S&P 1650. When we were coming back in, late 2012 when this thing was turning. So, like I said, we've had this magic rotation in 2012 and the fall of 12. We basically, most of this year has been pretty lackluster, and now we're seeing a lot of these stocks break out, and that's why we went through this top 25. It was just, we wanted to see what it looks like. So
right.
Anyway.
Well, and another thing worth mentioning, half the stocks, 12 of the 25 on this list, they're negative for the year. They're not even underperforming the benchmark. They're actually at a loss this year. Another 4 are below benchmark at the 5.5%. So it still is a small subset of the small subset that's carrying this, as always.
And you know what? That's the same thing with every portfolio. I don't care if you're a mutual fund, VPM, Monte Carlo, whatever. There's only a small portion of the items that you own, of your constituents. There's this little segment that's going to drive all of the performance. You don't have to have every stock right. You don't have to have every index right. I mean, the classic example, if we went to the Trade Impact on like Global Equity 4, guess who drove all the returns? EEM.
Right.
49% or something like that last I looked, wasn't it? Something like that?
I believe so, yeah.
Yeah, it's monster. So one symbol was the driving force for the returns. And with the symbols, there's 5 in there. That can rotate. Maybe someone else ends up running the show. And that's how it works on portfolios. It's not about, I guess it'd be find all 10 of them and an index that everything's working like that, but it doesn't actually work like that. We have our all-time record for a 1-year performance, believe it or not, was 172%. Real money, an advisor out of Georgia. Bill passed away several years ago, but he was doing all the .com stuff. It was the 99 2000 run. It was incredible. I think he only had about 20 million. He wished he had every dime he had in there. But it was amazing, actual real performance. I remember all the hooping and hollering that was going on back in those days. He at that time in '99, he was one of I think 6 or 7 customers we had. We had just really gotten the company going. In '98, he was our very first customer, and I'd known Bill for 6-8 years before that. And convinced him to be a guinea pig. If he was here, he'd have a lot of stories to tell about the early days of VPM and things we worked out and did. But that was quite the run. And matter of fact, his other primary portfolio was up almost 90% that year. So he had quite the year, to say the least. And I got to tell the story because it's just too good. One of the guys that worked for him told me a story several years later. We were talking after Bill passed away, and I never heard the story before. But during that period of time, I guess performance does count. He said they had them 8 and 10 deep in their office for about 4 months opening accounts. When I met them, they were 200. They went to $400 million, and so I guess and they were in the community about 100,000, but the word spread very far through friends, and everybody wanted to do business with them. So I guess the search for alpha is ongoing, and if you find it, there is a benefit. But the problem was you couldn't recreate that anymore. But it certainly brought in some business, and it was really fun, especially for me just starting this company, to see something like that happen. It was like the holy grail at the time. It ends up that it's a lot more work than it looked like. It was easy that year, and even in some of we'd never seen anything like it, and it was like that before. But and Bill was actually a one of the premier stock pickers I've ever known. So he was good at his craft as well. So we have seen some pretty good returns in the 80s, 90s, but never the 170s again. So anyway, that was fun. Sorry for the story, but I think it has a lot to say about stock selection, and also some of those things go. And I remember we bought Qualcomm at $30, sold it at $700. I mean, you just couldn't do those things. I mean, it was absolutely. As a matter of fact, we kept reallocating the portfolio on the way up. I think we sold it 6 times. The average price was like $540 getting out on a stock we paid $36 for. It was fun. I'd like to have those days again. But the bottom line is, that's why we're reviewing these things, and that's the type of rotation you see. You never know where these next accelerations occur from what level. And like I said. The models are seeing stuff when we go through these trades. I'm so glad we have this show. I wish we had 1,000 people watching this, because I think there's things here that illustrate how our process is going to get you through these times, and ultimately this thing is going to roll over. I talked about it the other day that you're really looking at at some stage this thing's going to end, and they never end pretty. And the way this thing's going, especially if we did get a sharp acceleration, if this thing exploded up to 20, 70, 120 point just explosion straight up, that would be pretty unnerving, because those things never hold. So we'd probably see that's when everybody wakes up one morning and says, what did we buy, and why did we buy that? And then they start selling, and then there's no reason to own anything after that for a while. And I'm anxious. Mitch and I were talking about this earlier this morning, is that it would have been nice for the market to reset on a larger scale. It turns out if you're mid-cap, large, and small cap, you did see a reasonable reset on some of those stocks. But from an index standpoint, you didn't see it. It just wasn't there. Small and mid indexes, yes, but not really. There wasn't enough to really grasp onto. What's really nice is when you do see the bigger declines that help to reset the values in these stocks, and you can literally stair step this thing higher. And it's possible we saw very little. Matter of fact, maybe in Process Warrior, starting to set up for tomorrow's show, maybe we could talk about some of this rotation and how returns using a trade impact chart and some things like that. What do we have in plan for tomorrow there, Mitch? Do you recall?
Tomorrow we have planned to talk about deploying capital. What do you do when the market's at all-time highs, or really just take a look at the last year or so, the different phases of a portfolio, and what do you do in those situations where your portfolio is 50% invested or 100% invested or 100% cash? What do you do in those situations? So that's some of the conversation we're going to be having.
Okay. And yeah, and I like I said, we're not going to run out of things to talk about, that's for sure. And we're spending 5 hours a week on a show like this, and between the two shows, and trying to focus on different conversations. So I would say most of the what we call our tech lesson of the day really was about portfolio construction, today, and the way that returns are actually come into your accounts. And I think that's a lot of stuff that folks don't realize. If you were to be at your favorite mutual fund company today, you would see a lot of rebalancing, a lot of things going on today, repositioning equity around, and we've seen that actually in the last couple of weeks. We've been seeing some of this money starting to move around in more of an individual stock basis, but maybe upping bets in sectors and different elements. And there's some really good quality managers out there. They have some really good processes. They've got billions and billions of dollars. They should be good, right? It's just they manage. But they manage to take a lot of fees. Some of them are taking 2.5%, so they're getting paid for what they do, as they say. And then those of us out on this side of the street anyway are wrapping them even further. So some of the cost factors, we talked about that the other day. If you recall, Mitch, we were talking about how I think it was Morningstar did a bracket of the cheapest funds versus the most expensive, and the cheapest funds made the most money on a relative basis. So you have to look at some of those things happen. But I think
did you tweet that article, by the way, or?
I did not. I don't know if I did.
We should find that. We should put that up there.
Yeah, it should be. It should be out there. But those are the kind of things that you need to understand it, and talking to customers and dealing with the markets, or it's there are some realities of how this all works, and from a mechanical standpoint, that's what we're probably going to get into that. I'm not sure where the Warriors show's going at the moment. It's been on a path, and now we're about to enter into I guess more open source, if you will, because there's so many things about understanding how portfolios work, as well as utilizing and rotating assets. There's a magnitude of items that you need to do there. So I have to, in closing here with 4 minutes to go, I don't know, I believe this should show the split here. Oh, why don't I just do that?
I do too. There you go.
Yeah. So here we are at $93. 93.66 here, up 156 after a 7-for-1 split. If you think about that, that's even more dramatic. 155, you got a lot more shares than you had before. But anyway,
right.
To move this stock up, I need to bring up good old Apple, because it is on a tear. This is probably the bellwether. It certainly is within our system, right, Mitch? We have, it's like the number one holding, right?
And it's the number one holding on the S&P, and it's also the largest performer year to date.
Yeah, and number one in all of the portfolios that we have on individual stocks, as far as a common stock in the system. So let's face it, we're all following this one. I've got one of those right here, iPhone. A lot of us have these things, but I'm anxious to see some of how this performs with all this stock out on the street now, to see if they get the little guy / retail guy to come in and buy one share or $97 or something.
I have to wonder how many advisors and clients as well logged into their account this morning and were shocked to see it trading at $90 when it had been trading at the price that it was last week prior to the split. It goes back to those things where you got to keep track of the news on the stock, so that way you're not caught off guard when this happens.
Yeah, I know there were 3 stories on the headlines of CNBC about this. That's how That's how it was out there, because everybody's like, "Wait, what's going on?" And I thought, did the stock plunge? Anyways, interesting.
Yeah.
So okay, we're actually going to be on time today. We got about a minute and a half to go. We'll take one of the things I didn't look at real quick. Let me get over to the right chart here. I didn't look at my favorite intraday futures, and you can see once again, one of the things I look for just quickly is some kind of downward spike for this, or a big spike for a high to be signaled, and that's just not happening. So just from the standpoint, what to expect for the balance of the session is this thing is pulling back here. We're about another hour and so, probably about an hour and a half away from the next cycle from a 5-minute standpoint. So we're probably going to see this thing firm up, and most likely, looking at this charts here, it's a good chance that we've seen the high of the day. We did print up to the R2 number at 1955.40. One mention, and I don't know Do we have these numbers where the weekly numbers are out there anywhere? Are they?
Yeah, it's on Monday's commentary. We put out both the daily as well as the weekly numbers.
Okay.
So,
Yeah, so R1 is 1956.40 on the weekly,
Yep.
and R3 is 1972, and the Fibonacci price objective is 1973 that I talked about earlier. So there's a lot of things lining up that we're probably going to move up to that level, and there's a good chance on a weekly numbers that 1942.50 will not be penetrated this week. So we may not even see an S1 hit this week unless we see some weakness. It's certainly within striking range. It's 10 points from where we are right now, some volatility, but the ranges continue to be narrow, and the patterns continue to be positive. So I said we're going to be on time. We're going to be about a minute late. So anyway, folks, thanks again. Process Warriors tomorrow, noon Eastern time. Get a lunch, sit down, and listen. I may solicit a couple things out in the field. We may bring in a live advisor call in tomorrow. I'm trying to work on a couple things right now with some folks that we know out in the field to start to bring in some dynamics. I want to at least try one to see if we can create a real-time disaster on air. So anyway, folks, thanks again for coming, and we shall talk to you tomorrow at noon Eastern time.